Hello, everyone. It's Professor Reiko here. Just wanted to get back going here in our tax chapter, accounting for income taxes. All right, so what we're going to talk about in this relatively short video is what do we do when the tax rates change? Okay, so just recently we saw a big change in the tax code. Corporate tax rates went down, so companies had to deal with this currently, and or just previously they had to deal with this. All right, so assume the enacted tax rate changed after we recorded the deferred amount, either the asset or the liability, or it could be both. All right, so if that's the case, and that's what happened now, we already had deferred tax assets and deferred tax liabilities on the books. They were based on our current rates, what we knew the rates to be, and then those rates change. Well, if that's the case, we need to just update the deferred account balance, okay, to reflect the new tax rate. All right, so a few videos ago, we did a company roll-in. There were depreciation examples, a multi-year video, and we basically assumed that the enacted tax rate was 40%. All right, now we're going to change it to assume that it gets changed in 2007. So the first year in that problem was 2006. So if you go back and look, we did this journal entry, and this was done in 2006. Okay. So this is to record the deferred tax liability. The difference was, I believe, it was 15,000. Yeah, 15,000 at 40% to give you the 6,000 here. All right, so this is based on. So this right here is based on 40% was the tax rate. All right, so that's at the end of 2006. Now, when we go into 2007, we are saying, all right, let's assume the tax rate changed. All right, so what do we need to do? Well, here's the journal entry, but how do we go about thinking about that? Well, if it was 15,000 was the difference. So up here, this was 40 times 15,000. All right, so now we're saying it should be now 15,000 times 35%, which is 5250. So if you think about your deferred tax liability account, we'd already recorded a liability of 6,000, but now we're saying it really needs to be 5250. All right, well, how do we get that? We reduce it by 750. All right, so that is that deferred tax liability. And then the offset is to income tax expense. All right, another way to look at it is you can just take the difference times the change in the rate, which was 5%, and that's $750 either way you look at it. Okay, I think over here, this is a little easier way to think about it. We did this in 2006, and this needs to be the adjusted balance in 2007, and then puts us on the correct rate going forward. All right, so basically, if we lower the tax rate, okay, it's going to decrease both our asset and our liability. Okay, so let's think about that. So if it decreases our deferred tax liability, it also decreases our income tax expense. Okay, so this decrease in deferred tax liability is this one right here. Okay, the tax rates went down, so we decreased the deferred tax liability. But notice we also benefit from that because it decreases our income tax expense. Now, if the opposite, for those people that had deferred tax assets and we just lowered the corporate rates, all right, so that to lower a deferred tax asset, you're going to credit it, which means you're going to debit increased income tax expense. So those people took a hit on their taxes by lowering the deferred tax asset, which caused them to increase their income tax expense for that period. So depending on what companies had on their books, it affected them differently. All right, so just something to think about as far as a current. We actually have seen that just happen with the change in the tax rates that happened just previously. All right, so this is when rates change after we've already recorded the deferred amount. Okay, so what we're going to do next in the next video is we'll look at, all right, what happens if Congress has already voted and said next year the rates will be this and so forth. So meaning we're in the current year, but we know next year's rates will be different. How do we go about handling that? Okay, so this is a good little multiple choice question on a test. All right, a change in rates after you've already recorded it. You know, this journal entry right here, you know, what happens when we change it, you know, and this is a good little journal entry to ask in the form of a multiple choice question. So I'd keep that in mind when you're reviewing for your test. Right, so this, once again, changes in the tax rate after you've already recorded the asset or liability, and this is how we adjust it back to reflect the new updated tax rate. All right, so hopefully this helps a little bit. Stay tuned in for the next one as we start changing, assuming we know what the future tax rates will be and they're different than the current year. So that will be the next video. So tune in. We'll see you next time. Thanks.